introduce you to Shinanogul, a local Malaysian brand that's all about celebrating elegance and individuality for modern, modest women. First, what makes Shinanogul special? It is because our shawls are designed with comfort, style, and sustainability. Our shawls offer premium quality products like exclusive chiffon shawl and limited edition seasonal collection. So, whether it's for casual outing, professional event, or something special, there's something for everyone. Our boutique is located in Bangi Gateway, Selangor. We choose there because it's a strategic location with a lot of traffic, especially during festive season. The location was chosen for its visibility and earning potential due to the increasing demand for affordable yet high-quality hijab. Our goal is not just to success in Malaysia, but also to grow internationally. We want to empower women worldwide with shawls that are not only stylish but also eco-friendly and adaptable to all occasions. We believe every woman deserves to feel confident, strong, and beautiful when wearing our shawl. In short, Shinanogul is here with mission to make women feel strong, attractive, and confident enough when wearing hijab through our product. This is an adjusted trial balance for Shinanogul as of 31st December 2015. It is presented in three main columns. The first column is trial balance. Trial balance shows the initial balance of all accounts before adjustment. The second column is adjusting entry. The adjusting entry is adjustment made at the end of the accounting period to ensure account comply with the accrual basis of accounting. The third column is adjusted trial balance. Adjusted trial balance is the final balance after incorporating the adjusting entry. There is adjustment in trial balance. The first adjustment is utilities. An adjustment of 500 is added to bring the adjusted balance to 815. Adjustment number 2 is rental of premise. A reduction of 150 and 100 for adjustment lead to an adjusted balance of 4,850 and 9,900. Next adjustment is depreciation sewing machine. Depreciation of 5,900 is recorded, increasing the accumulated depreciation to 11,800. The adjustment for prepaid rent and prepaid utilities is 150 and 100 are applied. The adjustment for accrued salary is 400 is made and reflect as a liability. The last one for adjustment is commission received and discount received. Commission received and discount received will remain consistent, showing 4,000 and 364 respectively. So the adjusted trial balance for Shinanogul balanced perfectly at 304,464 for both debit and credit. The importance of adjusted trial balance is to ensure all expenses and revenue are recorded accurately, and it will reflect a true and fair financial position before prepare the financial statement. It also helps to identify any error in the accounting record.
This is a statement of profit or loss for Shinanogul as of 31 December 2015. Here's a simple explanation. Sales. Total sales 54,800. Less sales return 400 ringgit. Net sales 54,400 ringgit. Next, cost of goods sold (COGS) of opening inventory 10,000 ringgit, purchase 14,220 ringgit, last purchase return 600 ringgit, net purchase 13,620 ringgit, closing inventory 0, total COGS equals to 23,620 ringgit. Gross profit, net sales minus COGS equals to 30,780 ringgit. Other revenue, commission received equals to 4,000 ringgit. Discount received 364 ringgit. Total revenue 4,364 ringgit. Expenses, display mannequin 2,500 ringgit. Rental of premise 4,850 ringgit. Utilities 850 ringgit. Salaries 5,000. Depreciation of sewing machine 5,900 ringgit. Total expense equals to 19,100 ringgit. For net profit, gross profit plus revenue minus expense, so it will be 16,044 ringgit. The company made a net profit of 16,044 ringgit after deducting all costs and expense. This statement of financial position for Shinano Gold as at 30 December 2015 provides a detailed snapshot of the company's assets, liabilities and equity. Assets, non-current assets or long-term investment. Premise 10,000 ringgit, after depreciation 9,900, saving machine 59,000, after depreciation 47,200, motor vehicle 10,000 ringgit, after depreciation 10,000 ringgit, total non-current assets 67,100. Current assets, short-term resources, account receivable in Arabuti 15,730 ringgit, bank 126,064 ringgit, prepaid rental premise 150 ringgit, prepaid utilities 100 ringgit, cash 39,350 ringgit. Total current assets 181,394 ringgit. Total assets 248,494 ringgit. Equity and liabilities. Owner's equity or owner's stake in the business. Capital 32,000. Net profit 16,044 ringgit. Last drawing 450 ringgit. Total equity 47,594 ringgit. Non-current liability, long-term obligation, loan 200,000 ringgit. Current liabilities or short-term obligations, account payable and affection 4,000 ringgit, accrued salaries 500 ringgit, total current liabilities 900 ringgit, total liabilities 200,900 ringgit. Summary, assets 248,494 ringgit divided into non-current 67,100 and current 181,394 ringgit. Equity equals to 47,594 ringgit, representing the owner's contribution and retained profits. Liabilities 2,900 ringgit made up of loans, long-term and small current liabilities. This balance sheet reflects that Shinano Gold's assets are primarily financed through loan 200,000 ringgit and owner's capital, ensuring all financial resources are accounted for. The statement balances perfectly with total assets equaling total equity and liabilities. Based on our company vertical analysis, it is shown that the health of the company is low because the liability is 80%, meanwhile the equity is 19.15%. The company mostly financed by debt. For interpretation, gross profit is 35%. It means the company keeps 0.35 ringgit of every 1 ringgit after subtracting the cost of goods sold. A higher net company income percentage means the company is efficient at converting sales into actual profit. In this case, a 29% net profit margin indicates good profitability. For ratio analysis, Shinano Gold is using 3 types of ratio analysis to analyze our company's financial condition. There are profitability ratio, liquidity ratio, and efficiency ratio. The profitability ratio is a ratio that provides information on the performance of a business. A higher ratio indicates that the business is profitable and financially sound. This ratio can be classified into gross profit ratio and net profit ratio. In Shinano Gold, we implied the net profit ratio. Net profit ratio is measured in percentage terms. It indicates in terms of percentage on how much a business makes for every 1 ringgit it generates from sales. The higher the net profit ratio, the better the business is performing. The formula used to calculate the net profit ratio is as follows. Net profit ratio equals to net profit divided by sales times 100. The following is the Shinano Gold net profit ratio. 16,044 ringgit divided by 54,800 times 100. We will get 29.49%. Shinano Gold net profit ratio is 29.49%. This shows that Shinano Gold is in a healthy financial statement, as the above said that a higher ratio indicates that the business profitable and financially sound. Next is liquidity ratio. This ratio is also known as solvency ratio. It shows how much liquid assets a business owns. The higher the ratio, the better cash position of the business. The liquidity can be further classified into current ratio and assets ratio. Shinano Gold are using the current ratio method. Formula as expressed as follows. Current ratio equals to current asset divided by current liabilities. The following is the Shinano Gold current ratio. Current ratio is equal to 181,394 ringgit divided by 900, and we will get 201.55. Thus, Shinano Gold current ratio is 200 to 1. This shows a very strong liquidity position, as the liquidity ratio is greater than 1. It indicates that Shinano Gold is in good financial health and is less likely to face financial hardship. Furthermore, Shinano Gold is also using the efficiency ratio. An efficiency ratio is to measure how well the company uses its resources to generate income and make a profit. This ratio also can help company evaluate their operations. The efficiency ratio be further classified into inventory turnover and account receivable turnover. In Shinano Gold, we use the inventory turnover method. The formula is expressed as it follows. Inventory turnover equals to cost of sales divided by average inventory. The following is Shinano Gold inventory turnover equals to 23,620 divided by 10,000 ringgit plus 0 divided 2. Inventory turnover is equals to 4.724.
Feasibility analysis shown in the slides has 2 key parts, the table and the graph. Here is the breakdown. Selling price per unit is RM50, variable cost per unit RM25, contribution margin per unit RM25, and fixed cost RM20,000. At 800 units sold, the business reaches the break-even point, no profit, no loss, RM0 profit. Below 800 units, for example, 600 units or fewer, the business incurs a loss because revenue is insufficient to cover fixed and variable costs. Above 800 units, for example 100 units, the business starts making a profit. The graph visually shows the relationship between sales revenue, variable cost, fixed cost, and profit or loss. In green line, which is sales revenue line, is increased with units sold. In blue line is variable cost, also increases but grows at a slower pace due to lower variable cost per unit. Fixed cost line is dotted line, remains constant at RM 20,000. Lastly, profit or loss in grey line starts negative, reaches 0 at 800 units, which is the break-even, and then rises above the profit. The break-even point is 800 units, and profits grow steadily beyond this sale level.
Okay, I will be explaining question 3, which asks what happens if the selling price is reduced by 30%. So let's analyze this step by step. The first one is the original situation, where the selling price per unit is RM35 ringgit, variable cost per unit is RM25, contribution margin is RM10, fixed cost is RM20,000, break-even point is 2,000 unit, and at the 2,000 unit, the company breaks even, meaning total revenue equals to cost and the profit is 0. Now, the price is reduced by 30%, so we have to calculate the new price, which is the new selling price equals to RM35 times with 70% equals to RM24 ringgit 50 cent. After that, we have to find the new contribution margin, which is contribution margin equals to RM24 ringgit and 50 cent minus with RM25 ringgit equals to negative RM50 cent. This means the company lose RM50 cent per unit instead of making a profit. To break even, the formula is BEP equals to fixed cost divided with contribution margin per unit. However, in this situation, because of the contribution margin is negative, it is impossible to break even. So no matter how many units are sold, the company cannot cover the fixed cost. In conclusion, reducing the price by 30% is a bad decision because it leads to lose, and I will recommend management to either keep the original price or look for ways to reduce costs. Okay, next, I will explain the cost volume profit CVP graph based on the previous analysis where the selling price was reduced by 30%. On the x-axis, we have the sales unit starting from 400 to 4,000 units, and on the y-axis, we have the value in RM. Before reducing the selling price, we saw that the BEP occurred at 2,000 units because of the revenue equal cost and profit was 0. So now let's look at the graph. The solid dot line represents the sales revenue. As you can see, it's rising, but a slower rate because of the selling price has been reduced to RM34 ringgit 50 cent per unit. And the next one is the light grey line, represent the total variable cost, increasing as more units are sold. And the other one is the dotted line at 20,000, it's the fixed cost which remain constant. So here's the problem. With the lower selling price, the sales revenue line gets high enough to intersect with the total cost line. This shows the company cannot achieve break-even. The more units they sell, the more they loses because contribution margin is negative, which is negative RM50 cent per unit. In fact, the gap between sales revenue and total cost keep increasing, representing growing losses. So, reducing the price by 30% makes the business unsustainable, as shown clearly in the graph. The sales revenue line never meets the total cost line, making the break-even is impossible. And lastly, is this graph visually confirms that the price reduction should be reconsidered unless the cost can be controlled or the sales strategy is changed.